Thank you, Hunter, for that nice introduction. And of course, it's a pleasure to be working with Metastock. I changed my presentation a little bit today, just this morning actually, and it's based on something that I got in Facebook. You know how sometimes you'll get something in your Facebook if you have it, something targets you, maybe something about trading or health or some other topic that you may have shown interest in. And you'll get a video. And oftentimes, in my opinion, those videos run too long. Sometimes they'll be 40 or 45 minutes, and they're continually promising you something if you just stay with them. And oftentimes, that promise is never even delivered on. So you've wasted 40 minutes that you aren't going to get back listening to something that really doesn't have a conclusion. And today, what I got was about a 4 or 5 minute video where the gentleman promised me he was going to tell me two things. Those are the two things that he told me, and then he directed me where I could go for further information on his offer. And I found myself much more likely to be receptive to that idea than I am to the overly long presentation that's full of fluff and never really gets to the point sometimes. Excuse me. So, what I've decided to do is actually cut some of my presentation from what you see here a little bit, and I'm going to concentrate on two things. And those are the option combinations and particularly the risk reward and probability. And I will say before you go, oh, I already know all that, I think you may find that what I have to say on risk reward and probability is a little bit different than what you may be used to hearing, and really that's the point. I want to challenge the traditional wisdom. Now, just before we start, I think it's reasonable that you know a little bit about me if you're going to listen to anything I have to say. So, here is my actual option and stock account. This is not a hypothetical account. It's a real account with real money and real trading commissions, and all the results are net of all that. And these are percent returns by the current month, the 3 month period, 6 months, the year to date, and the last 12-month period. Now, these are real results, but at the same time, the past is not a guarantee of the future, but I think that they can at least serve as a qualifier for what I'm about to discuss. Okay, back to our presentation on what I want to tell you about options and about risk reward and probability. Okay, first off, what we're going to start with is options, and particularly option combinations. Now, if you're not familiar with options, I know that they can sometimes seem like they're a real complicated thing, but really they become clear very quickly if you just spend a little bit of time learning how they work. And unfortunately, there's so many resources available now on the internet that really isn't a task that you have to invest anything in other than a little bit of time. What I like about options particularly, and I think that it helps overcome almost all traders' one biggest concern, and that's the loss that gets away from you. Certainly, many accounts in our business have been lost, not through poor trade selection or any other kind of thing, but just from one or two trades that the trader let get away from them and resulted in accounts that are sometimes just gone based on one or two trades. And that's a common error. It's in the brain's DNA, I think, for people to try to let that happen or let that happen. So the option combinations that I will show you will eliminate that possibility because you know going into the trade that you have a very reasonable and manageable maximum loss. And that's important because no matter how far the trade goes offside, your loss is limited to that specific amount. Now, pardon me if you are familiar a little bit with options, but I have to go through the basics for the people that aren't here. Excuse me. Uh, Call options are basically or are bullish bets on a stock or an index. If you buy a call option and the index goes up, then you profit. If you are bearish on an index or a stock and you buy a put and that stock or index goes down as you anticipate, then you profit. So in that way, you can think of them just like ETFs. A bullish ETF is like a call. If the market goes up, then you make money. Now, of course, the inverse ETF, which is a bearish view in the market, if the market goes down and you're holding a bearish ETF, then your ETF goes up, you profit. So that's the same as puts and calls. Calls are essentially bullish ETFs, and puts are essentially inverse ETFs. So you can buy puts and calls straight out, of course, like you would an ETF, but that is certainly one way to use them, and I certainly have used them that way. It is the most aggressive way to use them, the most risky way to use them, the way where you can make the most money, but also stand to lose a greater proportion of your investment, perhaps all of your investment. Now, when we use options and combinations, we trade off a little bit. We define our risk to a very manageable amount, and in return for that, we are willing to accept, in the best case scenario, a more reasonable profit objective, which is not open-ended. But to me, that has proven to be a reasonable risk, a well-defined and controllable loss amount versus a still reasonable upside objective. Everything doesn't have to be a home run. Now, in using option combinations, we use what we call a credit spread. And I like to use the weekly S&P 500 options. They're called the SPY. These options are extremely liquid, and they have very tight bid-ask spreads, usually within a penny or two. The cheaper the option, the tighter the spread. If it's a less than $1 option, it will usually be a penny wide between the bid and the ask. They're very reasonable to get into option spreads, and they're very, very liquid. Now, I use strike prices that are 2 points apart in the SPY. Now, the strike price is essentially the reference point for the option. So, for instance, if you have a SPY call option with a 267 strike price, that means anything above 267, the call has what is called intrinsic value. If the market is 268 and the strike price is 267, the call has an intrinsic value of $1. If the market is 270 and the strike price is 267, the call has an intrinsic value of $3. Similarly for puts. Now remember, puts were bearish. So if we have a 267 put and the market is 266, it has an intrinsic value of $1 because it's less than the 267, the strike value. If the option or the SPY index goes down to 263 and you have a 267 put, you now have an intrinsic value of $4 in that put. So the further the market goes down, the more the put appreciates. Now again, I do not, for this purposes of our discussion today, I'm not talking about buying straight puts and calls. What we do is set up a combination. If I'm bearish on the market, I will sell an expensive call because it's going to go down if the market goes down, and I will buy a less expensive call for protection in case I am wrong. Similarly, if I'm bullish on the market, I will sell short an expensive put option because it's going to depreciate in value if the market goes up, and for protection I will buy a less expensive put option in case I'm wrong and the market actually goes down. So what this does is it locks in both a best case and a worst case scenario. So let's give an actual example. Okay, right now the SPY index is 267, and you can see the divider here between the colors indicates where the price is, but it closed almost exactly at 267, and the spreads here you see between the bid and ask are wider because the market's closed now, but during the day they are very tight. So if I'm bullish on the SPY, what I will do is I will sell the most expensive option and buy the cheaper option for protection. Okay, and I always use strike prices that are $2 apart. For instance, a 265 and a 267, or a 266 and a 268. Okay, so for this example here, what I'm going to use is the 266 and the 268. So I'm going to buy the ask price, let's say 65. So I'm buying 65 and I'm going to sell the 68. Now the bid and ask here is showing 82 to 90. Let's say I can get 85 or $1.85, which very likely is possible. So I'm buying 65, getting back, because I'm selling this one, $1.85. So I receive a net of $1.20. Okay, pay out 65, get back $1.85, receive net $1.20. Now let's look at the various scenarios that could happen here. The market is currently 267, so it stays flat, it doesn't do anything. At that point, my 266 put is worth nothing. Okay, it's market's 267, and the put's worth zero. Okay, at expiry. Okay, at expiry it's worth zero. It has an intrinsic value of zero now. When it expiry, it will be zero. My 268, on the other hand, if the market closes at 267, is now worth $1. So at that point, I have to pony up the difference between where the index closed at expiry and my strike price. So if it stays right where it is right now at 267, it doesn't change at all until expiry, which is about, in this case, a week or so. My 268 option will have an intrinsic value of $1. My 266 will be worth zero, so I have to pony up $1. But I've already received $1.20, so I'm actually going to have a net profit of 20 cents by the market going dead sideways. If the market, as I suspect, rallies to 269, well then both my 268 and my 266 put are worth zero. They have a zero intrinsic value and they are worth zero at expiry. And in that case, I pocket the entire $1.20 that I received in my credit spread. Now, that would work whether the market went to 271 or 272. It doesn't matter how high the market goes. As long as it goes above that higher strike price of 268, I make the $1.20. Now, let's say that I'm completely wrong. The market does not only not go sideways, but it goes against me, and it goes down to, say, 262. Okay, at that point, my 266 put is worth $4, the difference between 262 and 262, and my 268 is worth $6, the difference between 262 and 268. So I'm getting $4, but I have to pay out $6, so I'm down 2. But again, when we put the position on, we got $1.20, so my net loss is 80 cents. So that 80 cents represents the worst case scenario, no matter how bad of a market crash there is. So the market could go 100 S&P points against us, and our loss is limited to that 80 cents. So that's how we use options in combination to eliminate, to eliminate the chance that we have a disaster trade because we've already locked in our worst case scenario. We've got a situation where even if the market goes sideways, we make money. And we got a situation where if the market goes up even modestly, we're going to profit the whole $1.20, and the 80-cent risk compared to the $1.20 profit. The $1.20 profit is 50% bigger, so our wins are 50% bigger than our losses under this scenario here, assuming the market goes either way past either strike price. Now, as I'm going to show you later, if you combine that with a strategy that has 65 to 70% winners for decades, um, you have a scenario where you're making more than you're losing and you're right more often than you're wrong. That's a good way to make money over the long run, given the scenario again where your losses are always limited, so you can't really blow your account out on one bad trade that you didn't get out of. So that's the beauty of option combinations. Let me regain my slideshow here. Again, risking 80, profit potential $1.20, and as I'm going to show you later, when you combine it with the API strategy, which for decades has had um, at least 2/3 winners, you have a winning combination. Okay, just continuing on. Um, I just had a question there, sorry, and for the pause. The question was basically somebody already has my API system, and basically on Metastock saying it's one of the, well, whatever, some complimentary things, and can I give another, example? I was going to do this later, but let me get to it now. Then I've jumped ahead here a little bit. Um, so let me go back to my page here and and find my other example here. Um, yeah, I think this was the more aggressive example. Again, now the market's 267, so this time um, we can buy an option for $1.20, which is the 267, which is just where the market is right now. Again, this is another bullish scenario, and if we're buying the 267, then we go two strike prices up to the 269 because we always want it to be $2 apart in these option combination spreads. And we see here that the spread was 266 to 293. So, I think it's a reasonable assumption. 275 is probably a reasonable assumption here, or 280. Somewhere in there is about cutting the difference. So if we're buying say here $1.10, the difference between 5 and 14 will go $1.10, and we're selling this one here for 275 or 280. We have about $1.60 credit this time. Now, that's obviously a better deal because now if we have $1.60 credit, we can only lose 40 cents, and we stand to make $1.60. Now, let's look at the various scenarios. This time, because we got a bigger credit, it's a little bit harder for us. The market has to go our way just a little bit further. So, for instance, if it stays right where it is at 267, the 267 put's going to be worth zero because 267, it's exactly right there, right at the strike price, so it'll be worth zero. The 269 will be worth two. So we've collected $1.60, but we're going to have to pay out $2, so we're down 40 cents. And that's our worst case scenario if the market goes dead flat. Now, if the market only rallies even a half a point, at that case, our 267 is going to be worth nothing, zero, and our 269 is going to be worth $1.50. The difference between 267 and a half and 269. In that case, we'll have received $1.60, paid out $1.50. So we have a profit of not much, 10 cents to cover our transaction costs. So essentially, we need the market to rally about half a point, half a SPY point, which is really not very much at all, 5 points in the S&P index, in order for us to break even on this trade. But remember, it's also a trade where we're risking 40 cents to make $1.60, which is quite a nice opportunity. Now, if the market goes all the way up to 269, and I say all the way, that's that's not much. That's two SPY points, which isn't a lot. In that case, the 267s are obviously still worth zero, and now the 269s are worth zero. So we collect the whole $1.60. So you can see it's the exact same principle. This one just gives us a little more income to start, but also requires just a little bit more of the market going our way before maximum payout, or before our break-even point is reached at least. And the first example I gave you, a sideways market allowed us to break even plus a little bit. And in this one here, the market has to go a half a point before we break even, plus a little bit. But again, on this one, we stand to make more money when that happens. So I hope that example, again, at least gives you a rough idea or the concept, even if you don't understand it exactly, of how to use these credit spreads, because they can be quite powerful. Option prices change all the time, in the sense that sometimes there's more better deals out there than there is at other times. So you have to watch that, but you obviously want to sell the option for greater than $1 difference. So that means you're always standing to make more than you lose. Okay, and we always want to make the strike prices two apart, and we want our credit to always be greater than $1. Okay. I hope that's clear. Again, if there's questions later, please feel free, and I can go back over and get them. So let me restart my slideshow here. Okay, now we're going to go into what we talked about before in the introduction, which was probability and risk reward. And I'm not going to tell you here what's right or what's wrong. And in fact, I'm going to tell you just the opposite. I'm going to tell you, or ask you to consider, to keep an open mind. And I'm going to give you some facts to hopefully support the case that there is no perhaps right or wrong in considering risk reward and probability, at least within some broad parameters. This comes down to a philosophy of what the market knows. The market doesn't know where you got in. Okay? And but it does know what it's done recently, and it does know its recent highs and lows and how far it's come from those recent highs and lows. So traditionally, we've all been told, that risk reward is paramount and is most important, and generally the consensus being that you have to set your trades up so that you're risking one to make two or more. Okay? I would submit to you that that doesn't always have to be true. Again, I'm not telling you it is true or it isn't. I'm submitting the hypothesis that it doesn't always have to be true. And what people forget, I think, when they look at risk reward is that it's a teeter-totter. And the other side of that teeter-totter is probability. And we very rarely hear people talk about probability. We always hear them talk about risk reward. And when risk reward goes up, then probability goes down. It may not always be the exact relationship of 1 to 1, but it is always highly correlated inverse relationship. So if probability goes higher, often, well, your risk reward is probably going to go down. You don't stand to make as much on each trade if you have a highly accurate system. And if you're asking your system to provide a higher reward per unit of risk, then your probability is going to go down. And why does that make sense? Well, if you think about a system that wants to make 2 points or 3 points or 4 points or whatever per 1 point of risk, you're essentially asking that system or strategy to participate in a trend. If the market's doing its chopping around, then risking 1 to make 3 or 4 isn't going to happen because the market's not going to accommodate you. Okay? Now, you have to ask yourself then, are markets usually trending or are markets usually not trending? You can answer that question for yourself. And of course, it depends on what scale you're looking at. Now, if we took two trades and one of them has, say, a 70% accuracy, but it risks 1 unit to make 1 unit. And I don't think 70%, by the way, is crazy at all. I have mechanical systems that will certainly do that or better at a 1 to 1 risk reward ratio. You have a 70% accuracy at that, you have a winning system. Now, if you want to have a system that makes risks 1 to make 2.5, well, then it needs to be still 40% accurate. And interestingly, those two systems, the 70% and 1 to 1, and the 40% and the 1 to 2.5, will yield exactly the same results. Okay, so there is a teeter-totter there of probability and risk reward, and they're inversely correlated. And in my opinion, for my type of trading, I have found that it is easier to attain reasonable profits a higher percentage of the time than it is to look for these big gains, because if you don't get into a trending market and you can be in chop for extended periods of time, you aren't going to make any money during those periods because you're looking for more than the market's willing to give you. Now, this goes back to here what was on our screen right now, which is what the market knows. And as we talked about, I believe that you should consider adjusting your risk reward based on what has happened since you've been in the trade. I think the idea that you put on a trade, put your stop in and put your target in and then walk away, for all of us, may not be the best way of doing things. And I know that is a way that has been taught or prophesized that it's the best way or it's a good way, whatever. And it may be for some people. I'm just here offering you to keep an open mind that it may not be. Now, let me give you a real-time example that we've all been through. We have two trades that are entered exactly at the same price. We have a 50 tick stop based on our strategy. The first trade goes down 5 ticks and then it turns around and roars back our way. The second trade goes offside 40 ticks. So it's within 10 ticks of our stop. It's 80% of the way to our stop, and then it starts to turn around. Which of those trades, empirically, historically, is more likely to hit your profit target? Clearly, the first one. And you could test it to the cows come home, and it's always going to be that way no matter what your entry strategy is. That's just the nature of probability. Okay? Again, this is what we've already talked about here. 70% in 1 to 1 is 40%, where you're risking 1 to make 2.5. Which is better? It's up to you. I'm not saying one is better than the other. I'm saying they're both good. And in my book, and in my experience, it's much easier to get the first one consistently than it is the second one. but that may not be everyone's experience. Now, so what I would suggest doing then, based on our little example of trades that are going our way initially versus ones that aren't, is let's adapt to what the market information that has just been given us. 40 points offside, almost stopped out. Now it's trying to climb back. What do we want to do with that trade? Has our edge really worked? Based on everything that I've done in my own experience and work, no, it's your edge hasn't worked that time. So what I try to do in that scenario is change my exit. That exit may be even a small loss, it may be a scratch or a small gain, but I don't leave my exit at the initial exit that I'd set when I put the trade in. Okay, um, it's very unlikely to be hit in all my testing and experience. So I will adjust the exit based on what the market has done since I got in. What has been the price action since we got in? Is it telling me that my edge looks like it's going to be a winner this time? And when I say my edge, I mean that's my strategy, my edge, sort of like they have in Vegas. You need something that tells you what's probably going to happen, and that's my edge. So that's what I'm referring to there. So I adjust my profit targets based on what information the market has given me price wise since I got in. Now, especially, I will lower my profit target if the market has gone substantially against me. If it's gone more than 50% of the way to my stop, then I'd lower my profit target. Okay, somewhere around a scratch, sometimes even at a small loss. Okay, now the other way that I lower my profit target is by how long I've been in the trade. And I do this because when I test an edge, I will just say if XYZ happens, this is my edge, then I'm going to be out in 2 bars, 5 bars, 10 bars, 20 bars, and see exactly what kind of results that yields. If it doesn't yield good results like that, then it's truly not an edge. But you will find a point where there is the point of diminishing returns where that edge influence has worn off. So I take that information with me to actual trading, and if I'm in a trade, a certain number of bars, and it's just languishing or not doing much, then I will certainly lower my profit objective based on how long I've been in the trade, because it's telling me that my edge isn't doing what I would hope it would do usually. Uh, Again, this is a different strategy than just putting your stop and target in and then walking away. I adapt to what the market's doing. I don't dictate that, oh no, it should do this. This is my stop, this is my target, and my risk reward should be this. The market doesn't care about all that stuff. The market doesn't know where you got in. Okay, so I adapt based on the information that the market has given me rather than trying to dictate to the market with these static statistics that I think that I should be following. Okay, now this is something I'm going to skip over. Um, okay, break even stop loss strategies, multiple exits. Okay, let me just get my slideshow going here again. Okay, one other thing I wanted to talk to you about is adjusting the stop loss, which is the opposite of what we just talked about with adjusting the profit target. Let me just actually go to a chart in Metastock here, and we'll I'll show you more of an actual example. This is the API system that I told you about and how it runs, and we'll run that in a minute, and I'll show you the actual results. But I want to show you a little bit here about stops and so forth. So let's just conjecture that here on this trade here, our stop was here. Okay. And what I would suggest that you do on trades like this is, um, once the market starts to go your way, it's giving you information. If you're using a daily chart, what I usually use is two consecutive closes above my entry or two out of three closes above my entry. And at that point, I do not move my stop from here to break even. Okay, assuming this is my initial stop, and I'm just using it as a straight example right here. Okay, actually, no, let me, I've misspoke here a little bit. This is my initial stop right down here. Okay, once the market has gone my way two consecutive days or two out of 3 days, I do not move my stop to break even. The break even stop is it's it often doesn't work, and it's another topic I was going to get into, but like I said, I want to give you two thoughts today. What works in these types of scenarios is not to move your stop from here to break even, but to move your stop by 50%. So if I had been risking 5 points before, now I move my stop up to this second line here, where, and if we move my stop from here, we move it up to here. So if it was 5 points, now it's 2.5. Okay, so cut your stop in half. Do not move it to break even. Perfect example right here. Why you wouldn't move your stop to break even? You get in, you get some ways that it's going a little bit your way, and then it comes in backs and fills, which is normal. This kind of back and fill into around your entry point is normal. Okay, if it goes more than 50% of the way, then you're starting to get into question. But you don't want to get stopped out on trades that are backing and filling in a normal kind of pause. So only when the market starts to go your way do you move your stop, and then you only move it by 50% of the way. Okay, and what that also does, interestingly, is when we talk about risk reward, is that even when I start with a 1 to 1 or 1 to 1.5 risk reward, and I often use 1 to 1.5 to start, if I've moved my stop 50%, and the vast majority, well, at least certainly a high majority of time, that's going to happen, my 1 to 1.5 risk reward now is a 1 to 3 risk reward, and that happens in the majority of my trades. So isn't that a better strategy than trying to force down the market's throat that he has to be 2 to 1 or 3 to 1 all the time? Certainly, to me, it makes a smoother equity curve. Everyone's strategy is different. Everyone has different edges. It may not be yours. I'm just throwing it out there to keep an open mind, and don't listen to every market axiom that you've been told. Okay, so on to the edge that I told you I was going to tell you about, and it is available in Metastock. This is the API system here on your top of your chart, and it has buys and sells and exits built right in. It's mechanical. It doesn't need any judgment or input. Okay. One of the great things about it, runs end of day, and the system is tested and runs on the next bar's open. The next bar's open is the most unoptimized or least curve fit entry point that we could use, and 99% of the time a better entry point is going to be available. Okay, so rather than torture the data, which I easily could have done to provide an optimal entry point and make the equity curve look even better, what we wanted to do is make this usable. Okay, so 99% of the time you're going to be able to get a better actual entry than the open price after the buy signal. Okay, so that's the API system on top. I'll run it in a little bit and show you the exact equity curve going back. This is the scoop indicator underneath it. Scoop is an indicator that works on the most solid principle I know in trading, which is find a trend and then look to buy the dip. Okay, trends are not defined by above or below moving average. They're much more complicated than that. But if the histogram is blue, then we're looking for moves um, in the red line below and then turn up. Okay. Now there are, I'll put another template on here that shows you um, how that can help you. We've actually got little numbers. This is the template that's actually the most I would say conservative. It's better for intraday. I'll show you one in a sec that's better, or that will give you more trades on daily. But you can see there's labels here, 1, 2, and 3. 1 is the most aggressive entry. Really, it's more of a get ready. And 2 and 3 are the points um, where the lower risk entries are. Now, the diamonds here are also a great filter to look for trends. As I said, whether the market is above or below a moving average is not a trend. When you see these diamonds, that means the market's strong enough that you can look to buy dips. Okay, so it's actually a strong enough trend that the next dip, say in the next 30 or 40 bars, whenever it occurs, you can buy. Okay, I will give you one here that has more opportunity like that. The diamonds are a little easier to come by, so you get more dips in your you get more dips and you get more numbers for your buying opportunities. Works long and short. You can see here red diamonds, and we got the numbers. If you get red diamonds with no numbers, then it doesn't. Then there's no entry from the short side. Okay. I promised to run the system, so let's do that. You can see the results. The system runs run it on the SPY here. Okay, you can run this the scoop indicator and the diamonds and number system on any market, any stock. Doesn't matter. You can certainly run the API system as well on any stock, and we'll substitute a few stocks in here in a minute. Important numbers here: the average profit to loss. The average profit's a little bit bigger, a little bit more than 1-to-1 than the average loss, and the system has been about 67% accurate back, for decades. Okay, the equity curve, very smooth right here. Okay, and again, this is purely mechanical. I can show it to you on, let me just go back, get the template again for the system. And you can even run it on hourly. Okay, it doesn't look like there's quite enough data here for me to run it on hourly, but you can see that it will run it hourly or weekly or whatever else time frame that you want to run it on. Let's see if we look on Amazon. Okay, here I just need to, I think I'm going to have to change this back to daily, and I have. Okay. Okay, just let me apply the template again. Okay, and here it is on Amazon, same thing. You can see going back that I haven't, it's not curve fit, it's not anything. It uses the exact same rules on everything. And as you probably know, if you've done any testing at all, if you're curve fitting something to a specific set of data, when you take it to another set of data, it's not going to work. Um, Let me give you another stock that's been, and that's how you can tell that the system's actually good when it works on data that it hasn't seen before. Let me let me go to another stock which has not performed as well at all as Amazon or the S&P, and that's General Electric. Uh, okay, I'm going to have to call up a template on this one as well. But again, as you can see, General Electric's been opposite of the market, and the system has adapted and has been issuing sell signals. And you can see how it works with Scoop as well. Again, histogram's negative, Scoop comes up here. This is where you want to be selling, right around here, right where the arrows are. The system and Scoop are complementary techniques. They are not the same. The system is not based on Scoop. It's based on similar things, but not exactly. Scoop is something that's an indicator that will run on any market you're looking at on any time frame. Okay, and again, the API system, which is the mechanical system, important things to know about it are that it uses the opening price for entry and exit, such that better prices are going to be available most of the time, and it still gave you the equity curve it showed you with an average profit that's greater than an average loss and winners 2 trades out of 3. A great combination with the option credit spreads I showed you before. And the other important thing is that you can run this on a bevy of stocks and you're going to get reasonably good results. And that tells you that it hasn't curve fit to any one particular piece of data because it uses the exact same rules on every stock or index. So I think that ties it up for today. If there's any questions, be more than willing to scroll through here and answer them. Okay, yeah, it looks like there are some questions still on the options. Um, Again, there's so many resources out there for the options, so let me just reiterate the important things that I would take from today. Is that we're using the SPY. I'm using strike prices that are 2 points apart. I'm looking for credits that are greater than $1. And when I have a credit that's greater than $1, that means that I'm always going to stand to win more than I can lose. And if I'm using a system that I can win more than I can lose in combination with the API strategy for entry and exit, which is right 2/3 of the time, 2/3 winners, winners greater than losers, over the long run, you're going to do very well with something like that. Okay, so the options again, to look for 2 strike prices apart. You're buying the cheap, you're selling the more expensive, and it really is as simple as that. Option credit spreads, they're called. Um, uh, Tons of resources on the net for free. It's not as complicated as it may sound. Don't be put off by the fact that you may not have seen this before. You don't completely understand it right now. You need to understand that your risk is limited, and um, it solves that big issue that a lot of people have in trading. Okay, as far as risk reward and probability that I've talked to you about today, we summarize again. Not telling you that one is better than the other. I'm telling you that not only with regard to risk reward in trading, but to a lot of things in trading, uh, to keep an open mind. A lot of the things that have been pushed at you come from the brain's sort of wired desire to define things, but the market is the exact antithesis of human nature, and it's not going to let you, it's not going to be dictated to. You have to adapt, you can't dictate. Okay, so in that respect, I'm encouraging an open mind with a lot of things about market axioms. Of course, you can't be risking, $1 to make 5 cents. Um, be reasonable, but neither do you have to have 2 to 1 or 3 to 1 or anything like that. And in fact, once you get above 3 to 1, those kind of trades are very, very rare, at least in my experience. It's really hard to find 5 to 1 risk reward trades. So that summarized the two things I wanted to talk to you about, and I hope that you got something out of this. My website, if you have any questions, you can reach me there. Um, um, okay, yeah, here it is. Here we go. Website is jdtradingsystems.com. Um, and you can have any questions, you can reach me there. There's more information here. Thanks for coming, and I hope you enjoyed the presentation.